Economist Stephen Roach said the V-shaped recovery of the United States economy is rag, and the dollar could drop 20% this year. According to Yale economist and former bank president Stephen Roach, the United States economy recovery after the recent increase in coronavirus cases and new restrictions is rag, while the dollar could drop another 20% due to lower interest rates and a widening budget deficit. The economy is sleeping before our eyes, Roach said in an interview with CNBC's Trading Nation newspaper on Monday, but the markets don't seem to care. Explaining the recent rise in United States stocks to all-time highs, Roach said investors are focusing almost entirely on Federal Reserve monetary policy. The markets are really focused on one thing, and that's why the Federal Reserve keeps interest rates at zero no matter what, he said. He told CNBC this condemns the markets to examine literally everything, from the political upheaval to the possibility of a double fall to a shattered V-shaped rebound. The markets seem to care. Markets also focused on the possibility of more incentives under elected President Joe Biden and Democrats who won the elections that would give them control of Congress last week. The Democrats' victories in Georgia allowed the markets to survive unprecedented scenes in Washington, D.C., where pro-Donald Trump protesters raided the Capitol building last week. More incentives are appropriate given the continuing severe economic hardship, Roach said. He said it would still have consequences. Roach argued that a higher budget deficit would reduce domestic savings and increase the current account deficit, combined to hit the dollar with its overly lax monetary policy. I see another 15 to 20% drop in the broad dollar index this year, Roach said. The dollar has fallen more than 7% against the currency basket since January 2020. He said it reflects not only the current account deficit, but the strength of the euro. Most importantly, Roach added, keeping interest rates at zero by the Fed would prevent a normal rate hike that could otherwise raise the dollar. Roach said stimulus may cause inflation down the road, but he said with aggregate demand remaining weak in the United States, I think it's going to take a while before that show up. Economist warning, the US stock market bubble will eventually burst. Last week, veteran investor and market guru Jeremy Grantham warned that the stock markets are in a bubble that will inevitably burst. He said the US stock market was now valuing more than it did on the eve of the Great Crash of 1929. Markets responded by continuing to rise, but does it make sense? If you are an investor in the United Kingdom stock market, you will probably find his warning surprising. Despite recent increases, the FTSE 100 is still not close to pre-COVID highs. This largely reflects the structure of the index, with relatively low representation of high-tech companies whose wealth and share prices are rising during the pandemic. It is predominantly dominated by banks, energy companies, and miners. On the contrary, the US S&P 500 is definitely technology-heavy. Also, there is some discount on the UK markets for the supposed negative effects of Brexit. But in the US market, Grantham definitely has a meaning. As the economy fluctuated, the stock market continued to rise, so it is now much higher than before the pandemic hit. One of the most widely used metrics for evaluating market valuations is a measure developed by economist Robert Shiller. It averages the corporate earnings of the previous 10 years and compares the number obtained with stock prices. The cyclically adjusted price earnings ratio, CAPE, is currently higher than it was at its peak in 1929 and not far outside of the record levels recorded in 2000, just before the dot-com crash, so the warning lights are flashing. However, this is not certain. Bond yields across the developed world are close to zero, and in some cases actually negative. actual returns are definitely negative, as there is still some inflation overall. If you adjust for negative real returns, then even the US stock market, never mind someone less highly rated like the UK, it doesn't seem overvalued. Indeed, the gap between the earnings yield on US stock and the real return on US bonds seems relatively generous, roughly 3.5 PC compared to minus 0.5 PC just before 1929 major crash and minus 1 just before the dot-com crash. On the basis, you could even argue that US stock seems to be at pretty good value, but do negative real bonds have to continue? Of course, in general, market operators believe it is. That's why bond returns are like this. However, this does not mean that they are right. In essence, bond yields are very low because at the global level, there is a desirable surplus of savings above the desired investment. This threatened to lower aggregate demand and force central banks to keep interest rates too low and pump money into the system. The reasons for this situation are much debated among economists, but whatever the ultimate reasons are, it does not have to continue. When COVID is well and truly off the beaten path, there will be a tremendous return on aggregate demand. Moreover, looking at the longer term, demographic effects will likely reduce the desired savings. Meanwhile, there are a number of factors that can increase the real investment demand, including opportunities created by artificial intelligence and robotics. The result will be an increase in equilibrium real estate rates and bond yields. Undoubtedly, in the near future, central bank policy will stop this, and possibly anything else, from causing significant negative effects on bond yields. The US Fed has made it clear that it will not try to raise interest rates immediately, even if inflation exceeds the 2 PC target. This means that as inflation rises and rises, real interest rates will fall further beyond their current negative level. This could further increase asset prices across the system, creating the basis for a significant bullish surge in stocks. Still, this possibility bothers me. If central banks are determined to keep real interest rates negative, inflation could rise to uncomfortable levels. Do they just sit back and let this happen? There will be serious political and economic consequences. Another rise in stock markets will further increase wealth inequality as stocks are disproportionately held by the rich. In contrast, small savers keep their money in deposits whose value is eroded by inflation. They would wear out again. Moreover, the higher the stocks rise over the next few years, the greater the subsequent correction will be. I think governments and central banks will initially try to take other measures to limit inflation in the hope that they can avoid raising interest rates, but in the end, this cannot be successful. At some point in the future, there is only an increase in inflation, but also an increase in real interest rates fueled by bond yields. As this happens, it will hurt equity valuations. In an ideal world, central banks would only gradually tighten policy and allow bond yields to only gradually rise, perhaps accompanied by only a gradual decline in real equity values without a market crash or major financial collapse. But accomplishing this will be a superhuman task. In general, markets gradually do not respond when there is an economic transformation or a sea change in policy. In recent years, global stock markets have enjoyed abundance. Prices skyrocketed far beyond what you think could be reasonably justified by real economic performance. It may not be yet, but I suspect this pattern will reverse at some point as global stock markets perform below the real economy. In short, I suspect Grantham will prove wrong in the near future, but looking further, I have a bad feeling that it will be right. If you make any investment or legal decision, it is advised to consult an expert before making this decision.